Welcome to Clatch Radio. This audio and video were created for academic, entertainment, and comedic intent only. Nothing presented should be construed as investment advice or a recommendation to buy or sell any security. Welcome to Clatch News, concise by design, allergic to excess. Today, we are cracking open the analyst report on the absolute behemoth that is UnitedHealth Group. And I have to say, for a company this big, the story is surprisingly dramatic.
It really is. I mean, you usually think of these big healthcare stocks as sleepy defensive plays.
Yeah.
But the setup here it's fascinating. Analysts characterize UnitedHealth not just as an insurer.
No, not at all.
They call it a diversified healthcare giant.
Right, because they own everything. It's the insurance, yeah, but then they have Optum, which is the service side. They're the payer and the provider.
Exactly. That vertical integration is their whole identity. But this is where the narrative has really shifted. It's not just about getting bigger anymore. The primary driver is a huge pivot toward AI-driven productivity.
I saw that. They're targeting, what, $1 billion in cost savings?
$1 billion. And that's not just for show. They're trying to offset some pretty serious revenue drops.
Okay, so the market's expectation is hinging on this one idea.
It is. The key assumption is that UnitedHealth can pull off what some are calling a beautiful deleveraging.
Beautiful deleveraging. Okay, that sounds like a yoga pose. What are we actually talking about here?
So think of it like a race. On one side, you've got these external pressures just squeezing their profit margins.
Okay.
On the other side, you've got these internal AI efficiencies cutting costs. The beautiful part happens if the cost cutting, runs faster than the squeeze.
So if the AI really works, they win. Got it. Let's look at the positive side first. Why do analysts still like this stock?
Well, first and foremost, the economic moat.
The Optum ecosystem.
Exactly. Because they own the doctors, the data, the pharmacy benefits. They have a competitive advantage a standalone insurer just can't touch. It's hard to compete when someone owns the whole field.
And the numbers back that up, don't they?
They do. Their operational efficiency is strong. I mean, they're posting a return on equity, or ROE, of 18.48%.
And for context, that's just a measure of how good they are at making profits with shareholder money.
Precisely. And almost 19% is very, very good for a mature company like this.
And then there's the price tag. The forward PE is sitting at, what, 14.62?
Right. And for anyone not glued to a terminal, that basically means the stock is historically cheap. It's kind of on sale after the recent crash.
Okay, but things don't go on sale for no reason. There's always a catch. Let's flip the ledger. What are the risks that have everyone so spooked?
It's the government. The big one is regulation coming from the Trump administration. They've proposed a flat rate for Medicare Advantage.
Which sounds stable, I guess, but I saw management called it profoundly negative. Why is flat so bad?
Because medical costs are not flat. They're rising. So if the government pays you the same fixed amount, but it costs more to treat the patient.
That money comes right out of your pocket.
Right out of UnitedHealth's pocket. It's a shock to the system.
And that leads to the execution risk. I read they're projecting a loss of 1.3 million members.
Yes, and a potential 20% hit to earnings. I mean, that is a massive blow, and you can see the damage in the technicals.
The chart.
The stock is trading way below its 200-day moving average.
In plain English, that means it's lost its momentum. The uptrend is broken.
Exactly. It's what traders call a fallen angel. The market is basically saying, we don't trust this anymore.
So you have this tension. On one hand, a dominant, super efficient market leader.
And on the other, this severe legislative correction trying to freeze their rates. It's a classic case of what I sometimes call the redistribution pulse.
The redistribution pulse. Okay, break that down for us.
It's a cycle. When one company gets too dominant, too profitable, the system eventually corrects itself. And that correction, it usually comes from the government.
So it's not an accident. It's the system pushing back.
It's the system saying you've won a bit too much and we're changing the rules. It's a pulse.
That is fascinating. It reminds me of something the boss, Bruce Springsteen, might say if he were looking at a stock chart.
Oh, yeah. What's Bruce's take on managed care?
You can build a castle on the hill, but sooner or later, the town comes for its share. That ain't bad luck. That's just the redistribution pulse beating in the heart of the city.
That's the lens, not prediction perspective.
This has been Clatch News, efficient, skeptical, and done on purpose. Thank you for listening to Clatch Radio.